In David Ricardo's classical political economy, the figure of the capitalist farmer occupies a structural vulnerable position that reveals the deeper logic of how land rent determines profits over time. The capitalist farmer doesn't own land, he owns capital. His role is to organize production by advancing wages to laborers, supplying tools and inputs, and coordinating cultivation in anticipation of selling the agricultural output on the market. Land, however, is monopolized by a separate class, the landowners who extract land simply by virtue of ownership. The separation between ownership of land and ownership of capital is not incidental in Ricardo's model. It is the institutional condition that allows rent to rise independently of productive effort, and in doing so, compresses the profit margins of the capitalist farmer. The starting point of Ricardo's analysis is the recognition that land differs in fertility and location. Some plots are naturally more productive than others, yielding greater output with the same application of labor and capital. When population is small and food demand is limited, cultivation is confined to the most fertile lands and no rent is paid because there is no scarcity advantage. In such a situation, the capitalist farmer costs consist primarily of wages and inputs, and profit can be relatively high. However, as population grows and demand for food increases, society is forced to bring progressively inferior land into cultivation. These inferior lands require more labor and capital to produce the same quantity of output, which raises the cost of production at the margin. In Ricardo's framework, the price of agricultural produce is determined not by the best land but by the worst land that must be cultivated to meet demand. The marginal land earns no rent because it merely covers the cost of production. If it earns less, it would be withdrawn from cultivation. Once this marginal price is established, all superior lands generate a surplus relative to marginal land. The surplus the surplus doesn't accrue to the capitalist farmer who operates the land, to the landowner in the form of rent. The capitalist farmer, despite being more efficient on better land, cannot retain this surplus because competition among farmers bind up rents to absorb the entire differential advantage. As a result, rent rises not because landlords contribute to production, but because scarcity forces cultivation onto worse land. Every step down the ladder of fertility raises the market price of food and expands the differential gap between superior and inferior land. The gap is converted directly into rent for the capitalist farmer. This means that any natural or locational advantage of the land he rents is monetized by the landlord, not retaining not retained as profits. The farmer's role becomes increasingly managerial rather than entrepreneurial. He coordinates production, but the structural surplus flows upward to the landowning class. The mechanism has direct consequences for profit. The capitalist farmer's profit is what remains after paying wages and rent out of total output. As food prices rise due to diminishing returns on land, the subsistence cost of labor rises as well. Ricardo assumes that wages tend towards a subsistence level determined by the cost of maintaining the laborer and his family. When food becomes more expensive, nominal wages must rise to prevent real subsistence. This wages this rise in wages further reduces the residual surplus for available for profit. Thus, profits are squeezed from both sides simultaneously, raising rent on the land side and raising wages on the labor side. Crucially, the capitalist farmer cannot simply raise prices to restore profitability, but because prices are pinned by the cost structure of marginal land. He attempts to charge more, he will be undercut by other producers operating at the same market price. Competition ensures that any surplus above cost is competed away into rent. In this sense, Ricardo's model portrays capitalist farmers as trapped in a system where they can bear the burden of rising costs but lack the power to appropriate these gains generated by scarcity or productivity differentials. Over time, this process creates a symmetrical decline in the general rate of profit. As profits fall, the incentive for capital accumulation weakens. Capitalists invest only so long as profits justify the risk and the effort of investment. When profits approach a minimum threshold, accumulation slows, innovation declines, and economic expansion loses momentum. The capitalist farmer, once the dynamic engine of agricultural growth, becomes increasingly constrained. operating at thin margin under the shadow of rising rent. This dynamic also explains why Ricardo views landlord as fundamentally unproductive class. Rent in this theory is not a reward for investment or improvement, but a consequence of natural scarcity and differential fertility. The landlord's income rises precisely because production becomes more difficult for society as a whole. From the standpoint of economic growth, rising wages represent a transfer of surplus away from productive classes. Capitalists and workers tend towards a class whose income doesn't expand productive capacity. The capitalist farmer, despite orchestrating production, finds his role progressively hollowed out. In the long run, this rent profit antagonism leads Ricardo to his famous vision of the stationary state. As profits fall towards zero, capital accumulation ceases. The economy reaches a condition in which output, population, and capital shock stabilize, not because society has achieved abundance, but because further growth is choked off by diminishing returns to land and the relentless rise of rent. Capitalist farmers continue to operate, but without growth, innovation, or expanding opportunities. Landowners continue to receive high rents, workers subsist, and the dynamic energy of capitalism dissipates. Ricardo didn't argue about the outcome was immediate or unavoidable. In the short run, he acknowledged that technological improvements in agriculture and the importation of cheap food through foreign trade could delay the process by reducing the pressure on land and wages. Nevertheless, these were postponements, not solutions. The underlying structure, finite land, population growth, the differential fertility, remained intact. As long as capitalist farmers depended on rented land, their profits were structurally subordinate to rent. In sum, the situation in which capitalist farmers orchestrate production on rented lands leads, in Ricardo's model, to an inherent conflict between rent and profit. As cultivation expands to inferior land, rent rises automatically. Wages increase to meet subsistence needs, and profits are steadily compressed. The capitalist farmer, despite being central to production, becomes the class most exposed to the squeeze. Ricardo's analysis thus transforms what appears to be a technical issue to a land fertility into a profound critique of how property relations shape the long run trajectory of capitalist economies.